Shane, good to see you. Today, we're talking through 3 strategies to minimize your Social Security taxes. Many retirees are surprised to learn that above a certain income, Social Security is taxed. In retirement, it's important to know how all your income streams will be taxed and how to mitigate those taxes. So let's start with the basics. How are Social Security taxes calculated?
So the way that the government comes to the taxes that will be, placed upon your Social Security is through what's called the provisional income calculation. So if you look at the chart here, you can see if your tax or if your provisional income is less than $32,000 a year, married, filing jointly, you won't have to pay any tax on your Social Security. But if you're above that, you might fall into a 50% or an 85% bracket for tax on your Social Security. Now, this doesn't mean by any means they're going to take 50% or 85% of your check. It simply means that amount will be applied to your taxes, and you'll have to pay your prevailing tax rate on either 50 or 85% of the Social Security that you receive. So, how do we calculate that provisional income figure? It's 50% of your Social Security and all other sources of taxable income. Once you derive that figure, you go to the chart and figure it out from there. So, 50% of your Social Security, all other sources of taxable income.
Interesting. Okay. So now let's talk through the 3 strategies to reduce your taxable income. And the first strategy that you recommend is consider converting your tax deferred accounts to Roth accounts. Why is that?
Well, these tax deferred accounts that we've accumulated over our lifetime, we've built these up for retirement income, of course. But the problem with them is when we go to spend them, uh, they trigger a taxable income stream, right?
Right.
So an IRA distribution of 401k, those dollars come out taxable, and that will eventually drive up your Social Security tax. But another note is it'll also drive up your modified adjusted gross income and your IRMA and your Medicare premium too. But back to the Social Security topic, the reason we recommend converting these dollars over to tax-free or never taxable, as we call it, is that it will reduce the Social Security tax on your Social Security benefits.
Interesting. Okay. And the second investment is consider shifting your income. Excuse me. The second strategy, consider shifting your income investments. Some investments generate taxable income, others are non taxable. Explain that, please.
That's right. You got to make sure you pay close attention to which income streams are generating taxable income, which are generating tax-free income. We use a couple different vehicles around here to generate, both. We can work in either direction, but you want to make sure you pay close attention to how you have things arranged and how it's going to affect your Social Security taxes. And just pay close attention to those income streams as they come your way in retirement. Make sure they're done in a strategic way.
Right. And then the third strategy, rather straightforward, simply delay claiming your Social Security benefits.
Sure, and this is something that can be done, right? Delay claiming your benefits until a time when your taxable income sources are going to be lower. But that doesn't always make sense for folks, especially if you've accumulated this big IRA, this big 401k for the purpose of retirement income. You're going to want to spend it, right? So that doesn't always make sense, but it is definitely possible, and a properly prepared plan to help you account for these things and decide when the best time is.
hmm It's nice to know there are strategies that exist that we can start utilizing today then to help us in the future. So, Shane, if somebody wants to talk this
Absolutely.
through, what's the best way to reach you?
Best way to reach us is by phone or online. Our phone number here is 602-456-1928, or visit us online at winstonandcompanies.com.
All right, Shane, thank you.
Thanks, Erin.